Thank you for joining our webinar. My name is Sandra Ivanova, and I'm responsible for the business development at the company. Right next to me is Violeta, our senior research analyst. And today's webinar will be about commodities. We will present you a few topics on investing in commodities, different types of commodities, and also more insights, statistics, and we'll get really into depth into the topic. So here is our outline. As I said, I'll firstly present you leverage shares as a company. I'll present you the main characteristics of our products and also our recently launched ETCs. Then my colleague Violeta will present you a broad overview of commodities, explain you more about commodity trading, also present you the differences between commodities and stock trading. She will go also more into depth about commodity exchanges. And then from then on, I'll talk about advantages of investing in commodities and also the importance of portfolio diversification. So let's start. First, leverage shares. Leverage shares is a pioneer in the industry and launched as an ETP provider in 2017. With the only goal to meet investor demands for leveraged instruments that are safer, transparent, and easily tradable. We are a European leader in leveraged and inverse exchange traded products, offering experienced traders magnified exposure and efficiency when buying stocks on leverage. We offer different kinds of leverage factors going from 5x to 3x, 2x, and also in the short version, we have a broad range. We offer also exposure to the daily performance of popular stocks and investment teams. I would also like to present you a few of the main characteristics of our products. First of all, our exchange traded products are 100% physically backed, meaning there's also no credit risk. Working with independent market makers, we are able to provide guaranteed liquidity. We also have our products in multiple currencies, so investors can choose if they want to trade in USD, dollar, euro, or funds. Our products are also SIP, ICA, and UCITS eligible. We are very transparent about our fees, and our fees comparable compared to other products are pretty low. A very important part when investing in leveraged products are, of course, the losses. Since you don't have to open a margin account with our products, also losses are capped to the initial investment. And we work also with the main exchanges across UK and Europe. We're listed on London Stock Exchange, Euronext Amsterdam, in Italy on Borsa Italiana, and in Germany on Xetra. So as I mentioned, starting the webinar, I would like to present you our newly listed ETCs, exchange traded commodities, also connected with the topic of our webinar today. And those are Brent oil, natural gas, copper, and WTI oil. All of them are exchange traded commodities and are fully collateralized. As I said, UCITS eligible, and they aim to reflect the daily changes in percentage terms of Brent crude oil, natural gas, copper, and WTI crude oil. Now, my colleague Violeta will tell you more about commodities, and I'll give her the word.
Thank you, Sandra, and hello, everybody. Welcome to our webinar. So let's get started and go to the essence of the webinar and demystify what is commodity trading overall. So basically, commodities are unique assets defined as raw materials that are used to produce finished goods, including agricultural products, mineral ores, and fossil fuels. Commodities are physical goods that are bought, sold, and traded in markets, unlike instruments such as stock and bonds that exist only as financial contracts. The commodity market is one of the oldest, biggest, one of the most liquid, with highest trading volumes and very easy to access. Commodities like iron ore, crude oil, and precious metals are raw materials that power the global economy. They offer unique opportunities for professional investors to profit from the ever-changing prices, but investing in commodities requires specialized knowledge and may carry more risk than conventional assets like stocks and bonds. The combination of volatile price movements, high liquidity, and availability of diversification makes commodity trading highly attractive to traders. But commodities are not all the same. So let's look at the main types of commodities. Basically, we can break them down into four major categories: energy, metals, agricultural products, and livestock. The energy market includes oil, natural gas, coal, ethanol, and uranium. Energy also includes forms of renewable energy like wind power and solar power. Commodity metals are generally divided into two groups: precious metals and industrial metals. Precious metals include gold, silver, palladium, and platinum, while industrial metals include iron ore, tin, copper, aluminium, and zinc. Agriculture covers eatable and non-eatable goods. Eatable goods include cocoa, grain, sugar, and wheat, while the non-eatable products cover cotton, palm, and rubber. Under the livestock, we have all live animals such as cattle and hogs. The prices of commodities shift constantly as supply and demand changes throughout the world economy. For example, the war in Ukraine led to higher grain prices, while rising oil production in the Middle East could depress the global price of oil. Investors in the commodity market aim to profit from those supply and demand strength or reduce risk through diversification by adding different asset classes to their portfolio. So what is commodities trading? How to trade commodities? Commodity trading is the exchange of different assets, typically futures contracts, that are based on the price of an underlying physical commodity. With the buying or selling of these futures contracts, investors make bets on the expected future value of a given commodity. The best way to trade commodities is to match your trading personality and tolerance for risk. Depending upon your tolerance for risk and favored commodity, there are several ways you can trade, each with their own advantages and disadvantages. The more traditional ways of trading commodities are by buying futures and investing in commodity ETFs, which is gaining big popularity over the past decade. But generally, we can gain access by trading physical or spot commodity, futures contracts, options, exchange-traded funds and exchange-traded commodities, CFDs, or commodities company. So physical commodity trading involves producers and consumers who trade goods which require a physical delivery. This strategy is only practical for value-dense commodities such as gold, silver, or platinum. Even then, investors will pay high markups of a spot price on the retail market, and speculators and traders who want to take advantage of expected price changes in commodities generally trade derivatives. Moving to futures, futures trading is the most common way to trade commodities. Futures contracts are basically agreements between two parties to buy or sell a specific quantity of an underlying asset at a predetermined price on a specified future date. Futures contracts are generally standardized, trade on exchanges, and require margin deposit to secure the position. Futures trading is best suited to professional investors who know how to trade these products. The participation of retail investors, however, in futures markets is minimal. Options trading gives the buyer the right, but not the obligation to buy or sell a commodity at a specific price and date. Options contracts are similar to futures contracts and are more suitable for professional investors as well. Exchange-traded funds and exchange-traded commodities are the most appealing product to retail investors by far. These funds combine the money from many small investors to build a large portfolio that tries to track the price of a commodity. The fund usually buys futures contracts to track the price of the underlying commodity, and the commodity ETFs, we can say, that truly democratize the commodities trading game to all investors because they are low cost, readily accessible, and highly liquid. Investors only need to pay a small amount of money to gain exposure to specific commodity, unlike spot or futures trading. Investors incur a small management fee to the commodity fund, but that is really negligible. CFDs stands for contracts for difference. CFDs are financial contracts that pay the difference in price between the open and closing trades. CFDs are a derivative product, and when traders enter a CFD, they do not own the asset. They allow investors to trade the direction of commodities over a short period of time with the use of high leverage. And finally, commodity stocks are another option to gain exposure to a commodity. For example, for exposure to oil, investors could buy the stock of an oil refining or a drilling company. For exposure to grain, investors could buy shares of a large agricultural company or one that sells seeds, for example. These sorts of stock investments follow the price of the underlying commodity. If oil prices go up, an oil company should be more profitable if the price of oil is going up as well. So let's have a look at the characteristics of the different instruments. From the summary we had a minute ago, it looks like exchange-traded funds and exchange-traded commodities are the most popular, most easily accessible, and buying ETFs and ETCs, investors have ownership, similarly like buying shares, options, contracts, and physical commodities. We have to say here that management and security costs for buying the physical commodities are extremely high. That's one of the reasons why they're not appealing a lot to retail investors, while management and security costs for ETFs and ETCs are relatively small. One advantage of exchange-traded funds and commodities is that there is no expiry date. Futures and options contracts have expiration, and they usually require specialized knowledge how to trade them. That's why options and futures markets are primarily for professional traders. We don't have leverage when we talk about exchange-traded funds and commodities. However, it is very important that investor needs to invest a very small amount of the original futures contract to gain exposure to their preferred commodity. And I guess this is one of the biggest reasons why ETFs and ETCs are gaining so much popularity over the past decade. So let's move to the advantages of commodity exchange-traded funds and exchange-traded commodities or notes. So basically, they offer several advantages to investors interested in gaining exposure to any type of commodities. The most important one is cost efficiency. Investing in individual commodities, we've mentioned, can be quite costly and may involve transaction fees, storage cost, and incur other expenses. Commodity ETFs offer a cost-effective way to gain exposure to multiple commodities with lower transaction costs compared to trading futures contracts. Accessibility is another very big advantage. ETFs provide a convenient way for retail investors to access commodity markets without the need to directly buy and store physical commodities or trade futures contracts, which require very advanced knowledge. The shares of ETFs can be bought and sold through regular brokerage accounts, just like the way we trade shares. And last but not the least, ETFs are traded on stock exchanges and enjoy abundance of liquidity. They're generally more liquid than investing directly in physical commodities. Investors can buy and sell them throughout the trading day on any market through a regular brokerage account. So let's move to one of the most important aspects of our presentation. This is the factors affecting commodity prices. The commodity market, like other market sectors, experience volatility and is heavily impacted by multiple factors. Commodity works well in a supply and demand system. When supply is high but demand is low, prices fall. And when supply is low and demand is high, prices rise. Investors, professional or retail traders can work out supply and demand levels by looking at the publicly available information and benefit from big price fluctuations. As the supply and demand for commodities changes, the price of the commodity will also change. The fundamental rule is that commodity prices will rise with increasing demand. Prices will also rise when there is a fall in the overall supply or inventory of a given commodity. On the flip side, the price of a commodity will fall when faced with decreased demand and increasing supply. Economic factors such as inflation, interest rates, and exchange rates play a crucial role in determining commodity prices. With rising inflation, cost of production escalates. Likewise, high interest rates increase the cost of borrowing money, while changes in exchange rates affect the competitiveness of the commodities. All these factors together cause rise or falls in commodity prices. Political and geopolitical factors are very important when we look at the commodity as an asset class. Some commodities are produced in regions that experience a great deal of political uncertainty. For example, crude oil is largely produced in countries around the Middle East. This means that the price of Brent and WTI can be heavily influenced by tensions that historically occur in that region. Trade restrictions and embargoes also impact the demand for certain commodities. Environmental factors such as natural calamities, climate change, and alike also impact prices of commodities. For example, droughts or floods can affect the supply of agricultural products, while hurricanes or oil spills can affect the supply of energy commodities. Currency movements are also very important because most currencies are generally priced in US dollars. As the value of the US dollar rises and falls, so the prices of the commodities. For example, if the US dollar experiences a sharp rise against a basket of major currencies, this could see a fall in the prices of commodities such as crude oil, as well as other energy, precious metals, and agricultural products. Mother Nature also has a decisive role to play in determining commodity prices, especially in the agricultural sector. Favorable weather may result in a bumpier harvest, leading to an oversupply of a commodity, whereas adverse weather can result in destruction of a harvest, leading to a shortage in the supply of a commodity to the market. So why commodity trading is so popular among investors? There are three reasons: the high volatility, the high liquidity, and the abundance of trading instruments. Commodities are like the lifeblood of the economy, and their market prices are driven by real-world forces such as geopolitics, supply and demand, the commodity supply chain, policy-level decisions, and even the weather. All of this contributes to significant volatility in commodity prices. Many commodities are highly liquid, meaning that there are many buyers and sellers trading these commodities at a given time. This degree of volatility can make these commodities more attractive to traders due to the relative ease of entering and exiting a position. So let's have a look. This is just an example. Let's have a look at the chart of oil and how all of those factors we were talking about can impact the prices. So first we have the Russia-Ukraine war, which occurred on the 22nd of February 2022. On the day when the newspapers announced that Russia invaded Ukraine, we've seen a significant spike in the price of WTI, with the price rising in few trading sessions to almost $140. For the next couple of months, the price stayed elevated between $100 and $130, and then gradually unwinded, driven by demand concerns as the global economy is slowing down. In June this year, once Saudi Arabia, which is a major oil producer in the Middle East, announced voluntary output cuts, the price of crude oil from about $67 experienced a very sharp rise to around $96 in the space of 2 months. Also, when Hamas attacked Israel, we had a very small bounce of around $10, and even that the conflict didn't escalate, the price of oil continued to decline. Let's look at the price of gold. We are showing here some similar events that you read every day in the news, and most probably you are aware of those global trends, how they are impacting the price of the precious metal. So roughly around $2,000, when the Federal Reserve started hiking interest rates in March 2022, the price of gold started experiencing fast and significant decline. Once the market started preempting that the Federal Reserve is done with its interest rate hikes, which coincided with the US dollar picking up, we've seen over 2-3 weeks gold building a small bottom and then a strong recovery back to the $2,000 level took place. Again, back in October, we had just a natural pullback to unwind overbought conditions in gold. But as soon as news broke the wire that Hamas attacked Israel, we've seen a significant rally in the price of gold, with the price actually reaching recently all-time highs. So given that the gold is very sensitive to interest rates, and we finally have broken the previous resistance levels, to me, this means one thing. Once the Federal Reserve starts cutting interest rates in 2024, we can see higher prices unfolding from here. So to conclude, with commodities trading, using leverage is much more common than With stocks trading, this means investors only put down a percentage of the needed money for an investment. For an example, rather than putting down the full, say, $75,000 for the full value of an oil futures contract, investor might need to put down roughly around $7,000 to buy exchange-traded products through leverage shares. The contract generally requires to keep a minimum balance based on expected value. And if market prices starts moving against us, investors would like to face a margin call. I'm talking about futures products now, and need to deposit more to get back to the trades required minimum value. Trading on margin can lead to greater returns than stock markets, but it can also lead to greater losses due to the leverage used. Small price moves lead to big changes for our returns, meaning that our potential for gains in the commodity market is high, but also the potential for losses. Commodity also tend to be short-term investments, especially if we enter a futures contract with a set deadline. This is in contrast to stocks and other classes where buying and holding these assets long-term is much more common. Overall, commodity trading tends to be more high risk and speculative than stocks trading, but it can also lead to faster, larger gains if our positions are in the right direction. Commodity investing is a strategy that is best suited for sophisticated investors. Before making any trades, we need to carefully understand the commodity price charts and other forms of research. Since market moves can lead to large gains and losses, investor needs high risk tolerance as well. If investors invest in commodities, it should only be a portion of the total overall portfolio value. For investors and traders who are looking to diversify their portfolio in an asset class, that offers a higher risk-reward profile, and many investors use about 20% or less of their overall portfolio for those higher risk-reward products. And this is the segment where commodities trading live. And now I would love to pass back to Sandra again to finish our webinar.
Thank you, Vili. Thank you very much. It was great insight you gave us. And where you left off, I'm going to pick up and we'll talk more about the advantages of investing in commodities. As you see on the slide, I've pointed out three main aspects. We have portfolio diversification, hedging against inflation, and simplified trading experience. One of the most significant reasons why commodity trading is on the rise is its simple process. As you know, previously trading used to be a tedious process and opening trading accounts took as much time as 3 weeks. Nowadays, as you all know, opening a trading account takes less than a few hours, and the whole process of trading commodities, equities, bonds, and whatever assets we choose is much, much easier. One of our main goals at Leverage Shares is to simplify the trading experience for investors and to make it as easy as possible and as convenient as possible. And that's one of the reasons we also chose to create our exchange-traded commodities, which I presented to you at the beginning of our webinar, which are on Brent, copper, WTI oil, and natural gas. A very important part is also diversification, which I will explain a bit later more into detail, but portfolio diversification is an essential concept in trading and investing. It helps balance out the overall risk associated with your portfolio, of course. And when one asset class underperforms, its negative impact it offers an asset class that performs well. One of the top reasons to trade in commodities is exactly this portfolio diversification. And as Violeta already mentioned, investing 15 to 20% of your total assets in commodities is what most experts recommend and what analysis show as best in a portfolio combination. Commodities have a negative correlation with the equity market. When commodity prices rise, their production costs increase and companies make less profit. Hence, the price of company stocks drops consequentially. When inflation is stable, stocks perform well. On the other hand, commodities fare well during periods of rising inflation. As a result, the two are viewed to have a negative correlation. And talking about inflation, I definitely want to talk also how commodities can hedge you against inflation. And as discussed, commodities are an asset class that perform well against inflation. For example, gold bullion does act as a hedge for investors during high inflation or low interest rate environments. And due to the negative correlation between stock and commodity performance, commodities are used to protect investors' portfolios, as I said, from inflation. And this is also one major reason to include them in your portfolio. And going from there, I would also want to expand why is it important to invest in commodities. Investors typically look to commodities allocation to provide three key benefits. As mentioned, inflation protection, diversification, and of course, return potential. This is the investor's biggest goal. Because commodities are real assets, they tend to react to changing economic fundamentals, which Violeta mentioned in the beginning of her part, in different ways than stocks and bonds, which are considered as financial assets. For example, commodities are one of the few asset classes that tend to benefit from rising inflation. A demand of goods and services increases. The price of those goods and services usually rises as well, as do the prices of commodities used to produce those goods and services. Because commodity prices usually rise when inflation is accelerating, investing in commodities may provide portfolios with a hedge. In contrast, stocks and bonds tend to perform better when the rate of inflation is stable or slowing. Faster inflation lowers the value of future cash flows paid by stocks and bonds because that future cash will be able to buy fewer goods and services than they would today. And going forward to one of our last slides is once again the main points and a visualization how an example portfolio would look. We have the bigger part in equities, we have a significant part in bonds, and as mentioned, we have 15 to 20% to commodities, or if you choose also exchange traded commodities, such the ones leverage as just listed. And I would gladly invite you to pose our questions, so me and Violeta can give you respectfully the answers to them.
And once again, thank you everybody for joining our webinar.
Well, it seems for now there are no questions. I guess it takes time to take all the information in. We remain available for further questions and answers. You can always follow us on LinkedIn and all social media for exciting content, market insights, and updates, of course, on our company and new product launches. Once again, it was great having you at our webinar, and stay tuned for the upcoming ones.
Thank you.